Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now we're trading in a larger range here of the dollar versus the Canadian dollar. When the high end of the range was reached, the dollar index, that old dollar index we're talking about, was testing weekly resistance at 87, which used to be support. Now there is a case where to hedge the position with volatility being high, a covered right hedge makes sense. The reason I'm saying that is because that dollar index is pretty much now going vertical instead of horizontal. And seeing as how that's the case, it's possible now to, since I have resistance, to actually sell upside protection. And again, if I get called away, I'll have to figure out a way to re-enter the position, but that's okay. So I'm using the resistance from the dollar index to determine when and how to hedge my currency pair, especially the ones that are brand new, like some of the currency pairs from the ISE here that don't have as much history. Okay. So we're moving on here now to the euro, and notice my chart of the euro here. I was saying back in July, look for a stage 2 breakout once the 30 weighted moving average reaches the trading range and buy 65 calls on the breakout. So here's my 30 weighted moving average, very, very close to the trading range. I'm trading between 62.50 and 65.50 at this point in July. Okay. It traded in that range for a period after stage 4 decline that went all the way back to November of 06, so it was a long decline. We used the trading range strategy, which included buying calls at the bottom of the range and buying puts at the top of the range, because it was a fairly small range at that time. We made our plan to enter the new stage 2 uptrend, if it happened, on a breakout through the top. I should mention, too, though, I just as easily could have entered on a breakout to new lows, a new leg down. I've mentioned in the past that you do not always have to break out of these consolidations to the uptrend. If you look at this higher one from 68 to 70 earlier in the year, we actually broke out to the downside. Okay, so the dollar wasn't finished going down at that point in time. It based for a period of time and actually broke out to the downside. So you can make plans for a breakout of either way, to the top upside or the bottom. But at this point in time, I'm kind of cheating to the upside again, because notice I did test those lows at 62.50, and then I had buyers buying at a little bit higher prices. So the picture was kind of looking to me like almost an ascending triangle, not quite, but pretty close. Ascending triangles, for anybody, is a series of higher lows with pretty flat highs where we have some resistance that has to be overcome. But we've got buyers willing to pay higher and higher prices when prices are pushed lower. So at that point in time, I made my plan. I had my little breakout here, occurred early in August, around 8:12 again. Notice I'm getting ready to run into a little bit of resistance almost immediately, so we have to keep an eye on that. Every time you base in these areas and drop, usually on a return visit, there's probably going to be some leftover sell orders that have to be filled before price can go higher. But the force of that breakout was pretty strong, and for a while there we did have to absorb the resistance, so we traded in a higher range between 67 and about 68.50 for a few weeks. And eventually, of course, at that point I'm looking at what are my possibilities to hedge this position. Now, it really hasn't gone very far, and of course I've got to keep in mind my costs. If I do have 62.50 calls, I have a bigger position to hedge than if I have 65 calls, because I bought a little bit later on, so that's going to weigh on my decision on what to do to hedge. I'm thinking again, if I'm expecting any kind of a moderate drop, I could use some kind of a spread, which would include taking advantage of just buying, for example, in this condition, buying the 67 put and selling the 66 put. So something like that, if I'm only expecting a moderate drop. And that, again, that's where the trader has to make their mind up. And to me personally, after a huge trading range and a big breakout like that, I'm not too keen on hedging that close to where the actual breakout happened, because there's always a possibility too of some kind of a retest, especially depending on which calls I'm trying to hedge, either the 62 trading range bottom calls or the 65 calls. So I wasn't too keen on actually taking any kind of a hedge. A few weeks later, we did break out of that range. We did start to move higher. Again, I drew my vertical trend lines here to focus my eyes on, oh yeah, I am going sideways, but I am going sideways and higher. So I want to keep track of the angle of my trend, because, of course, the steeper the angle on these trend lines, the more likely that trend line is going to be broken. And then, of course, I've got my what I call my intermediate term or long-term trend line for another possibility that I could trade at. So I jumped into using trend lines on this currency pair at that point. The current protective put hedge is closer than either the Australian or the British pound hedges. So the sentiment remained bullish, with the possible upside resistance at that time near 72 and 76. So a premium writing strategy makes more sense depending on when the long calls expire. And when I did this slide on 9/8, I happened to notice that with just 11 days to expiration, the September 72 calls have a 15-cent bid as the U.S. dollar rally continues. So I'm thinking, okay, so there's still a little bit of premium on these calls, even with 11 days to go. But there you go. Here's our next slide here on 11/10. And I noticed I wrote in here stage 1, there's our accumulation. Our stage 2, here's where I drew my trend line, and it's the same trend line that we were looking at earlier. And we've had several weeks that have actually tested and stayed above the trend line. And I was worried about some resistance between 72 and 78. And for a couple of weeks, I did touch that resistance area, and I was able to break through and test the higher resistance areas. You'll notice I have an oscillator down here, the relative strength index oscillator, which of course is beginning to tell me that the trend is probably a little bit overdone. But again, all your oscillators are always going to tell you that you're overbought in an uptrend or oversold in a downtrend. So do not take these signals unless one of these major trend lines is traded through. And by traded through, I mean get a weekly close through one of these trend lines to break the trend. So I've on this chart got a short-term trend line, an intermediate-term trend line, and a long-term trend line in case this trend wants to continue. Now, as I go on to the next slide, I notice here that I've pushed way, way up into this 76.80 bracket. Okay, so stage 1 accumulation down here at the bottom, stage 2 uptrend, stage 3 top if price breaks below 76, or another stage 1 accumulation if price ends up going higher. What would that mean? That would mean that people were buying dollars at higher and higher prices, accumulating dollars, and if we break out of the top of that range, we could go on and make new highs in this currency pair just as well as the other ones. So depending on your entry now, if you've got a 65 entry and you're at 76, you've got a wonderful gain. If you've got a 62 entry, 62 and a half entry, and you're at 76, again, it's a nice gain. You can be taking off part of this position every time you run into these resistance areas. You can plan for horizontal movement during this period of time to where you can actually the volatility on the calls above these areas is going to be very, very high, so there's possibility for some kind of a right strategy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.